Hey team, how you going? We're going to be talking about dividend reinvesting plans today, what they are, what the type of companies that issue them, the benefits for the investor, benefits for the company, the tax implications, and whether or not it's different to receiving it in cash as opposed to the tax obligations of being in a dividend reinvestment plan on an individual. And then we're going to go through when you would consider dividend reinvesting and when you may not really consider it, or it may not be in your best interest. Okay, my name's Andrew Mitchell. I am the founder of MitchiMoney, where we help people generate 6 figures plus in retirement using our proven perfect retirement blueprint money management course. Okay, so dividend reinvesting. What is it? When you're an owner of a company, and that means that you own shares, you're a partial owner, sometimes you get to share in those profits. A board of directors will issue a dividend statement, and that's basically going, hey, we've got this much money in profits. We're going to distribute that to some of our shareholders, usually. Okay, could be retained earnings, whatever it might be. So you'll get a dividend statement, and it will tell you how much per share that company is going to pay you. Lucky you. So what's the benefit for the investor? The benefit is the fact that the company is issuing it directly to you, the investor. And that means that you don't have to go through a stock exchange. You don't have to buy it through the market. So no fees. So you might save some commission or fees depending on your brokerage. Okay, so the second thing is that most of the time they'll issue it as a discount as well. Maybe 1%, maybe 10%, and it could be anywhere between. That means that you'll get it not only at a discount to the market, you'll also get reduction in fees as well. So that's always a benefit to the individual investor. Okay. Next thing is if you are an investor and you're reinvesting back into that company, you're going to get the compounding growth benefits as well. So if you took the money as cash and you didn't reinvest it, there's a missed opportunity cost for that as well. So not only are you getting the capital growth of your original investment, but if you reinvest the dividends over the next 20 years, you've got all of those dividends reinvested, and your capital growth will compound at the same time. They're the main benefits of a dividend reinvestment. And, well, it keeps it simple and automatic, so you don't have to worry about stuffing around with brokerages and all those sorts of things. Just automatically happens for you. Okay, well, why would a company issue or want you to reinvest your dividends? First and foremost, companies like capital in terms of cash, and that means that if you reinvest your dividends, it's like them raising capital. So they can go to the market and raise funds and capital through stock raises, all those sorts of things, but they've got their existing investors who already love their company. So they give them the option to buy more stocks, and that means they don't have to distribute the income to those people. They give them stocks in lieu. Company always holds stock, and then they can distribute you stocks instead of your cash. They can use that cash to improve the company and grow it even faster. Next thing is it also helps stabilize the company. And the reason I say stabilize the company is, let's just use an example. Let's just say the stock price has ducked down a little bit and there's a dividend to be issued. And you're on the dividend reinvestment plan. Most people on the dividend reinvestment plan are long-term investors because they believe in that company. So if the stock's down a little bit, some people might sell it thinking, oh, goodness me, a little bit worried. But people who are on dividend reinvestment plans, the company knows for a fact that you're going to get more stocks for your money. So you're actually going to get more stocks. So if you stay invested, your potential for getting even better gains increases. So it helps stabilize the supply and demand component. Not 100%, but it does give a little bit of stability in there, and that's why companies love it. Next thing that I actually missed is dollar cost averaging. So if you're a long-term investor and you're buying all the time, which is basically like your dividends buying or reinvesting, sometimes stock prices are up, sometimes they're down, and they're somewhere all between. So if you're buying all the time, you're buying when the prices are down and you're buying when the prices are up. So across an average, you're getting a dollar cost average investment strategy, which is a fantastic way to approach it as well. So they're the main two advantages for the investor. They get it for a better price, usually as a discount. They get less fees. They accumulate their wealth and compounding growth. And for the company's perspective, they get to keep capital and use the capital. The next thing is the fact that it stabilizes the supply and demand as well for the company. Okay, so they're the main two things. But let's have a look at the taxation components for an individual. So a lot of people think it's treated differently. And look, in the very simplest terms is if you reinvest your dividends, it doesn't matter whether or not you took it as cash, you have to treat it as cash from the company's perspective. So I'll use an example. Let's just say you invest in company A and you've got 1,500 shares. The company sits down, they decide that they're going to issue a 50-cent dividend payment per share, which means if you've got 1,500 shares, you're going to get a 50 cents payment for each of those shares. So the company's going to pay you $750. The company can give you two options. They can say, hey, let's distribute you $750 in cash. That cash would then go against your income, assessed income. So you would actually have to add that to your income. Next thing is they say, hey, if you don't, perhaps you might want to be a part of our dividend reinvestment plan. And what we can do for you is we can actually sell you these stocks at $10, which might be a small discount to the current trading price, whatever. And that means for your $750, you get 75 shares. If you sign up for it and say, yeah, sign me up, fantastic. So you haven't taken any cash. You get an extra 75 shares, so now you've got 1,575 shares as opposed to 1,500. That's fantastic. Next thing is that you still need to include that $750 in your dividend dividend assessed income field in your tax return for that financial year. So as you can see, as your portfolio grows, the amount of dividends you receive is going to be greater, and the amount that you can reinvest is going to be greater, which means your tax obligation is going to be greater as well. And this is just for an individual. Again, we're not talking about tax structures and trusts and all those sorts of things, and the weird and wonderful world that we can distribute incomes to lower income holders, all those sorts of things if we need to. Not talking about that. But the next thing you need to be aware of is that you need to be aware of the capital gains. So yes, your 1,500, let's just say you bought 1,500 shares at one time. That's fine. So when you sell those, you can actually then calculate your capital growth. But when you got the dividend income or your dividend reinvestment plan for your 75, they are very unlikely to be the same price that you bought your 1,500 of them at. So you need to keep records of what the amount is that you bought for the dividend reinvestment, the price of that stock at that time, and the date as well. And that's where it becomes really important. It can get a little bit tedious with your record keeping. There's apps and everything out there that can help you with that as well. But that's really important that you cover off on that. So when might a dividend reinvestment plan not be suitable for someone? Well, it's not suitable for a short-term investor. Usually it's a long-term investor. Why? Because you're reinvesting into that company. You've got faith that that company over the long term is going to grow in value. It's pointless to reinvest your dividends and then just pull them back out. It doesn't really make economic sense based on the parameters of economics in terms of the costs of turnover and selling and buying, all those sorts of things. So usually short-term investors won't apply or participate in a dividend reinvestment plan. So that's the first type of person that won't. The next type of things is not that you shouldn't, it's just that you need to consider it. So when you consider reinvesting in plan, you want to have a look at your whole portfolio. Whether or not you've got a balanced portfolio, whether or not it's a specifically set portfolio for yourself, you want to have a look at the diversification. Because if you've only got one large holding and you're reinvesting your dividends in that holding, you might want to have some diversification. So not to say that if you're happy with that, go for it. I'm not one here to tell you otherwise, but you've got to look at your diversification as well, because you can very easily unbalance your portfolio by putting more dividend reinvestments into one company, and you accumulate your assets faster in that one company than your other alternative companies. So it can very easily tip your portfolio off what you actually wanted, which is why I mean you just should review your portfolio every 3 months, and then that way you can stay on top of it, and you might need to buy some other assets to prop it up and change it around. But if you're happy with the diversification, you're happy with the strength of the company, and you're happy to reinvest your dividends, I think it's a fantastic way to compound your growth and accumulate wealth as well. So that's a perfect reason that you should be contributing to a dividend reinvestment plan. The only thing you really should be looking at is whether or not you're a long-term investor, whether or not you want to diversify further outside of your dividend reinvestment plan, and having faith in the company as well. Perfect dividend reinvestment plan is if you're an index fund investor. So you can reinvest your dividends back into that index fund ETF because your your index fund is already well diversified. Because if it's an S&P 500 one, for example, you're invested in 505 companies. And really the last one, and we've already touched on it, is the fact that when you reinvest your dividends, you take advantage of dollar cost averaging. You're not trying to time the markets. It takes the emotion out of it. It makes it more commercial, and you're just reinvesting your dividends whether or not the prices of the market's high, whether the prices of the markets are low, and you're getting a nice consistent capital growth in terms of that company as well. But the dividend reinvestment is only as good as the company that you're reinvesting in. So again, make sure that you're reinvesting in a company that you're confident that's going to give you those returns over the long term. So thank you very much. My name's Andrew Mitchell, founder of MitchiMoney. If you're looking for a software where you can absolutely keep your finger on the pulse and have 100% transparency between setting your goals, investing, improving your net worth, you should check out our MiTCHi.io software. All right, thanks very much. Hopefully that helped.